price usually retracing into the premium of the ranges that it creates right here. Price messing around more, stopping as many traders as possible. So what I would be doing in this type of situation as price starts pulling back. So in this one, we will talk about quadrants, about when you can and should expect a deeper pullback to take place, and when you should expect small quick dips into fair value gaps and fast explosion type of continuations towards the main draw on liquidity. So now what we have right here is a classic market maker sell model. We have original consolidation right here. Price builds buy side of the curve, pops out, hits a key level that we call a catalyst type of area, a key P array, or ideally a liquidity pool that price runs right here into that opposing bearish key P array, and from that point it gives a shift in delivery. From there, what we have is a potential sell side of the curve, and this is where we start focusing, of course, on the potential sell opportunities, hopefully with the main direction and the main flow what comes to the higher time frames and lower time frames. So obviously sell side of the curve is easier to trade. For me personally, what comes to building buy side of the curve, when we have that potential buy side liquidity pool with a key bearish P array right above, this is my scalping area. This is where I look for very quick in and outs. This is the area, this is the hard exit time for me. So this is where we don't want to stretch our targets. We want to catch quick plays. But now what comes to the sell side of the curve, this is very obviously can be a little bit more aggressive, especially if we have daily and lower time frames fully aligned on our side. So now the fractals that I want to talk about, and something that people really don't seem to use to their advantage, is understanding where price is about to accelerate and where price is usually taking more time before expanding. This is where you want to adjust your vision and adjust your view on the whole actual market maker model whenever you are trading it. So now one thing that I would suggest writing down, the first type of point that we want to focus on whenever a shift in delivery happens. So price running buy side liquidity pool into key P array right here, it tops out and gives a sharp shift in delivery, sharp expansion, and we start expecting for a sell side of the curve to take place. What we want to highlight is the reversal and the main draw on liquidity. So the reversal area is obviously this top right here, and the main draw on liquidity regarding market maker sell models is of course original consolidation. So when we do that, this is where we have the top and this is where we have the bottom. So the 50% area is right here in the middle from the reversal to the key main draw on liquidity, which is again original consolidation. So let me adjust that a little bit, somewhere around right here. So one thing that I want you to remember is that mostly deeper pullbacks that usually go into OT type of levels, OT Fibonacci is 0.62 to 0.79. So let me apply that and adjust it a little bit. So now this is where usually in the first half from the reversal towards the draw on liquidity, in the first half right here, when we have the middle point, this is where usually we see deeper pullbacks. This is where in most cases price retraces towards the OT levels, deeper into the bearish P arrays, breaker block, or the block, fair value gap. This is simply then we have a shift in delivery, price taking out a recent structure right here, us identifying a dealing range being this high and this low. This is then we want to focus on the premium side and premium type of P arrays right here, because usually when price is in the first fractal or around the equilibrium point from the reversal towards the main draw on liquidity, this is where we usually get deeper pullbacks. But now what comes to the second half from this key point, and again I'm talking about a range from this key point to the key main draw on liquidity, which is original consolidation, this is where most of the time we get quicker pullbacks, smaller pullbacks, because price gets so close to the main draw on liquidity that it usually just dips into the first P array. Usually that's a fair value gap and continues towards the main draw on liquidity, taking out the main target. So whenever you enter the second half, this is your traders very often start looking for deep type of pullbacks before continuing. That's very often a mistake, because usually what we will see in these type of situations are simple institutional order flow entry drill type of formations. This is what we call institutional order flow entry drill type of a situation. And price very simply inside of this leg right here, inside of this expansion, leaves fair value gap, price reaches into it and drops right towards the main target, which is original consolidation right here. So if let's say this is a 15-minute type of a market maker sell model, and on the 15-minute, what you see is price dipping into the fair value gap right here. This is where you would want to zoom towards the 1-minute or 2-minute type of time frames and look for the same type of confirmation, which is simply a clear high, shift in delivery, tiny pullback, and this will be your short entry to catch this last piece right here towards the original consolidation. But why a lot of traders miss these type of last moves is simply because they expect for price to retrace into the premium of this range right here. But as mentioned before, whenever price dips into the second half of this entire range from this point to this point, from key reversal to the original consolidation, midpoint right here, this is where we expect deeper pullbacks, price usually retracing into the premium of the ranges that it creates right here. And then we get expansion and price reaches into the second half right here. This is where price usually doesn't reach into the premium and gives the simple, quick continuation type of entries. And what I personally do and focus on whenever price does that, if again, this is let's say a 10-minute or 15-minute type of a market maker sell model. Inside of this area, if we have clear 10-minute or 15-minute bearish fair value gap right here and price trades into it, again, this is there. I zoom into execution timeframes, which for me is anything between 1 minute and 5 minutes. But usually if it's a 10 or 15-minute time frame for the confirmation type of entry, 1 minute or 2 minute is the best. You will see the clearest view in this type of situation. And there we are simply waiting for a simple clear type of reversal to continue pushing lower towards the main draw on liquidity, which is the original consolidation right here. So I hope that part is clear. Let me now quickly show you a real live example of that. All right, so this is what we have right here. On the left here, what we have is original consolidation. Price starts building buy side of the curve, which is again where we look for very quick in and out positions. But usually I personally even stay on the sidelines unless again it's very clean, very clear. Price trades towards a buy side liquidity pool, and around that area, what we look for is a key PD array. So looking higher, what we have is this bearish order block. But again, as price rejected it right here, I personally would look higher. And what we have here is this bearish fair value gap. But if we zoom in even further, what we have here is a balanced price range, because this bullish imbalance right here is overlapping bearish imbalance. So that point for us is balanced price range. So price runs buy side liquidity pool right into the key PD array right here. And after that, what it gives is a shift in delivery right here. So from this point, what we do, we take this first high right here and we find the middle point. So you can see that the middle point is right here. So in this first half, what we will be expecting to see on the charts is deeper type of pullbacks. Price messing around more, stopping as many traders as possible before it actually drops to the main target. So obviously, after price gives a shift in delivery with this type of candle, what we start focusing on is to get an entry inside of this whole area. So last type of expansion, price rejecting this bearish right here. So the most recent type of a tiny dealing range that would be a lot more clear on the 1 minute time frame is from this high to this low. So taking that, you can clearly see that price retraced into the premium of this tiny dealing range right here. This being the midpoint, price retraced into the premium. We get another entry around the mean threshold. Price messes around even more and then continues towards our main target. But overall, even though this whole delivery is kind of messy, you can see that price still respects bearish PD arrays. Price respected bearish order block right here. Then it respects mean threshold of this bearish order block as well. Then it respects and rejects this tiny bearish fair value gap right here. Notice that we had a few rejections here, here, and here, and eventually drops to the downside. So now from this point, looking for a scale in or another opportunity if you didn't get something clean in this first area. Now focusing on the second half from this reversal towards the main draw on liquidity being this original consolidation. What we can expect here is a quick type of continuation because price got so close to the main draw on liquidity that it's in a rush to complete this entire move. If this, let's say, is again, as mentioned, for example purposes and what I usually look for, if this is a 10 or 15-minute time frame market maker sell model right here, inside of this area, notice that inside of this second half right here, what price gave is a quick and sharp drop to the downside. And then what it left right here is a simple bearish fair value gap right here. So what I would be doing in this type of situation as price starts pulling back into this bearish fair value gap right here in this area, what I would be doing again, if this overall development market maker sell model is taking place on these time frames right here, I would zoom to the 1-2 minute type of time frame, looking for a simple reversal, shift in delivery on the execution time frames, and a simple short entry targeting the original consolidation right here, aiming to catch this last expansion to the main draw on liquidity, completing this 10-15 minute market maker sell model. And this is how identifying fractals, you don't really often miss trades, because if you would be looking for price to retrace all the way into the premium, let's say, of this dealing range right here, looking and expecting for a deep pullback, let's say towards this bearish order block, you would be simply missing the entire move. So what you want to be doing when you, let's say, have two candles, two imbalanced candles, you can go to the higher time frame until these two imbalanced candles becomes just one imbalanced candle. This is obviously when it gets a lot cleaner and easier to trade, or simply mark both of these two candles, and on execution time frames, simply wait until price actually tops out and gives a clean shift in delivery. So you can enter here or here, trading towards the main draw on liquidity, which is again original consolidation of the 10-15 minute type of a market maker sell model. So that is all for this one. This is how I identify key ranges inside of a market maker model. I hope you will find this useful, and we will talk very soon.